Hi everyone, Ben Dolan with Dolan Capital Advisors. Thanks for joining. Today we're going to be talking about catch-up contributions and super catch-up contributions within the Atrium Advocate 401k plan. There's been a lot of confusion around catch-up contributions, especially with some changes to tax law in 2026. Today we're going to go over the basics and make sure that you're well informed about how these work. So catch-up contributions allow those that are 50 plus years of age to save over and above the standard IRS limit into their 401k plan. There's also a new element to catch-up contributions called super catch-up contributions. And this allows those that are age 60 to 63 to save over and above the standard IRS limit, but also over and above the 50 plus amount deferral into the 401k plan. Catch-up contributions are especially important for those that have delayed retirement savings, and this is typical for physicians, right? Because physicians are in school for so long, and by the time they're done, they tend to have large financial obligations, and so they get a little bit behind on their retirement savings. So this is allowing you to catch up on some of those retirement savings within your retirement plan through work. In 2026, all savers are allowed to defer $24,500 into your 401k plan. For those that are 50 and above, you can do $24,000 in elective deferral, and then you can do a catch-up contribution of $8,000. And then there's the super catch-up contribution for those 60 to 63, whereby you can put the $24,500 of elective deferrals into the plan, and then you can put $11,250 above the $24,500 into the 401k plan. But there is a catch in 2026 that everybody needs to be aware of. So starting in 2026, for higher earners, those making more than $150,000 in the prior year, you must put those catch-up contributions into the Roth portion of your employer-sponsored retirement plan. That's something that is brand new for 2026, and it's part of the Secure Act 2.0, which mandated this change. And what it means is that you are going to be taxed in the current year for any catch-up contributions that you make. So you're still allowed to do pre-tax deferrals of $24,500, but if you're 50 and above and you do catch-up contributions of either $8,000 or $11,250 if you're 60 to 63, you're going to be taxed on that amount in the current year, and the monies will be put into the Roth portion of the 401k and grow tax-free in the future. So there is good news on that front. But if you're used to deferring income on your catch-up contributions in the past, you're not going to be able to do that in 2026. So it's really important that you know that. You also want to consider your ability to convert dollars and cents to Roth in the future. You don't have to do catch-up contributions if you're in good shape and you don't want to get taxed in the current year. Maybe you stop making catch-up contributions in 2026. Record keepers are required to differentiate between pre-tax savings and Roth savings. So as long as you're putting them into these different buckets, you don't have to worry about separating them. The record keeper is going to do it for you. Let's take a look at 2025 versus 2026 really quickly. So in 2025, you were, as someone who participated in a 401k plan through work, allowed to defer $23,500 if you're under 50. And then if you're 50 to 59, you could save an extra $7,500 for a total of $31,000, and you could defer all of that into the plan. If you were age 60 to 63, $23,500, and then $11,250 for a total savings of $34,750, and all of that would be considered pre-tax income. But now in 2026, you can defer more because there's an inflation adjustment to the standard contribution amount, so $24,500. If you're age 50 to 59, you can save $24,500, And then $8,000 will go into the Roth as your catch-up contribution, and you will be taxed on it, and your total saving will be $32,500. If you're 60 to 63, $24,500 deferral, catch-up contribution of $11,250. You'll be taxed on that $11,250, and it'll go into the Roth, and total savings of $35,750. Golden Capital Advisors is a financial planning and investment management firm. We currently manage about $200 million in assets. We have a fiduciary relationship with our clients at all times, and our firm is fee only, which means our only source of compensation is from our clients. Thanks for joining today. Really appreciate it.